Every time the central banks around the world do this, markets break. Hello, ladies and gentlemen, and welcome back. Today we discuss interest rates higher for longer. That's the story that everyone is reacting to. And of course, markets move down as per our expectations to the gap fill. But does this mean that the bulls are now done in markets? Well, not necessarily. And today we explain why timing is everything. A critical level throughout crypto, stocks, and commodities has just been reached. Let's talk about everything to do with that right now together. Well, welcome back everyone to the Daily Show. We'll be talking about news, macro, lead indicators, and the key levels that you need to be looking at on the hottest charts right now. But let's begin with Powell because he left the door open for a pretty big change. Higher interest rates at a faster rate hike. And really, he basically said two things. We're looking at a few important releases to make our decision. What does that decision mean? Most likely at this stage, 50 basis point hike in March. And the market doesn't like that. Why would it? Goldman and other big banks around the world really changed their expectations based on this speech. We moved from 5.5% to probably 5.75% terminal rate. This is the rate that the Federal Reserve is expected to get to, and it really opens that door for people that have been talking about 6% plus. I'll be putting a poll out on the channel today, so make sure to subscribe and answer that poll. Very interesting results to see what most of you think about markets moving forward and the interest rates of where the Fed gets to. So let's have a look at yield inversion, 50 years or 40 to 50 years. Basically, we have not seen yield inversion like this in a very long time. And this is telling us there's a clear disconnect between the Federal Reserve, which I like to think controls the 2-year, well, basically it does, and the market, which controls the US 10-year. The market's saying a recession's coming, and the Federal Reserve is saying we're combating inflation. We don't really care about what we're doing. We have to stop this, otherwise bad problems will occur. It's a damning chart, and certainly one where you start thinking about timing being very important over the next 12 to 18 months. We also know that 60.2% of economists now believe a 50 basis point hike is happening. That's a big difference. If you're interested in some of those charts, remember to follow our Twitter, links in the description down below, and come and check out all the fun as we post them in real time. So let's now look at terminal rates. This is the shift here. This top line is effectively what happened over the last 24 hours. We have an incredible spike in the forward yields. We've got a higher terminal rate happening, and then we have less cuts than any point over the last 3 months. Not even in October and December of last year did we see rates so high. Less cuts and a higher base terminal rate. Surely this is going to hurt some banks, and of course, specifically, it's going to put a lot of pressure on the financial system from earnings perspective. And this is where we get into some of the problems moving forward. EPS growth. When the Federal Reserve has done this in the past, and also when we've seen EPS growth turn negative, this has usually meant a decline, especially in growth stocks, is coming, or it has already started to be on the horizon. This is the forecast that, of course, Mike Wilson's going with. We've also seen ERP becoming a big issue. If you haven't watched some of our previous videos, I've discussed this several times before. But if we do see a recession, equity risk premium will become a big discussion point. And this is something that the markets don't tend to price in until the recession comes. So another kind of damning stat if it does end up happening. So what's the problem with the markets right now? Well, the good news is that we've got the sugar rush. That's, of course, due to basically people just spending lots of money. And why do we know that? Well, we've seen credit card rates increase. We've also seen an increase in consumer spending. And the month of January was very positive from an economic standpoint. You saw more house transactions, used cars went up. A lot of things started to look much more better, or better in general. Now, how can we explain this? Well, one of the reasons is not this chart, which is, of course, the Federal Reserve technically tapering their assets. That's usually coinciding with bad markets. And traditionally, it's one of those kind of leads that you use with the market and your overall concept. So, of course, then we have global liquidity. Has it already bottomed out? Well, I'm here to tell you that this has dropped in the recent weeks. And I think it's a huge reason why the markets are starting to weaken off. But we do have some central banks around the world, such as China, actually increasing they're realistically stimulus, they're cutting rates, they're trying to support their economy. And at the same time, you've got people like the US and, of course, Bank of England technically weakening their economies to try to deal with inflation. It's a counteractive world out there right now. And this world is global economy. So it has like massive implications. So the stock market's completely ignoring the bonds market. It's saying no recession, we'll have dips, but we're going to buy them. And it's a soft landing and everything's all good. I've used this chart a lot. In general, what is really happening is there's a disconnect. Ultimately, I'll always trust the bonds market over the stock market. They tend to be more correct. Remember, stocks trade off fear and they trade off greed. So realistically, if we're thinking about it, that doesn't necessarily fill you with confidence that they're efficient at figuring out what happens with economies. I mentioned at the start of this video that the Federal Reserve tends to break something every time they do hiking cycles. This is the fastest hiking cycle in recorded history, and you can't tell me that something doesn't break. My opinion is it's going to be zombie companies. And if you actually have a look into zombie companies in the S&P 500 or the Russell 2000, you'll find a lot of them. There's a lot of companies that are not profitable that could suffer throughout this time. So we mentioned timing is everything. Does that mean that markets are going to fall off a cliff right now? Well, probably not necessarily. But what it does mean is that you need to be on the watch out, especially for when the Fed pivots, because it tends to be when the Fed pivots, stocks start to fall a little bit more. Now, I'm not suggesting that it's the great financial crisis or even necessarily the dot-com bubble in terms of Fed pivots, but if they break something in history, then when they break something, the markets most likely will decline. And around 1/3 to 2/3 of the way through the pivoting story, that's usually where the markets do bottom off. Of course, subscribe to the channel if you're interested. We'll be following along that story should and when it does happen. So let's get into the here and now. Well, we've got annual seasonality that kind of shows us that March in particular and February, the middle to the middle of March, can be kangaroo-y to down. And then we tend to see more rallying in the back end of March into April. Now, this is during normal years. Obviously, it's not a normal year, but we've seen some of the seasonality playing out so far. We also know that volatility tends to spike in Q1 and Q3. So when's the most likely period for a recession to potentially start its ugly head? Potentially Q3 of this year or even Q1 of 2024. There was a crazy article that I actually posted, and it's over on our Twitter, and it said that there's never been a recession, during the period of the third year of a president. Isn't that interesting? 5 recessions on record of the election year, and the post-election year has the most. But there's never been one. So is 2023 going to change or buck the trend? We'll find out. Smart money versus dumb money. This is more about inflows. I like to think of it as smart money is completely neutralized around the 4K level. Basically, every inflow chart I look at, whether it's this type of thing or anything else in terms of big flow data, it's showing me that positionals have been placed as a neutralized market. So effectively, there are so many people consistently not knowing what's going to happen yet, and they're very concerned on their timing. Big fund managers don't want to miss out on the rally, if there is one, and they also are prepared to hedge against some losses that could be coming. So this is what we're seeing directly on the charts right now. If you're interested in finding out more about some of the things that FX Evolution on this channel does offer, make sure to jump into our competition. It's free to enter. You'll be able to win a whole bunch of great prizes, and we're drawing this in around 6 days. It's just one of our ways of saying thank you for supporting the channel. And of course, if you do win the major prize pack, which is the #1 prize, I'll be seeing you very soon in the May group mentoring. So of course, I look forward to meeting whoever that lucky person is. Enter today, links in the description. Let's move over to the US 2-year versus 10-year. Here is where we get the inversion, and it doesn't matter which interest rate we realistically add to the chart, we'll be finding inversion across the board. Over 50% plus of all of the different bond combos are inverted. That usually tells me that the bonds market is respecting a recession coming, and that it's never been wrong. So in 50 years of recorded history, when we've gone past 50%, it hasn't been wrong. So what does that mean for safeguarding people's money? What are they doing right now? Well, of course, if we're seeing the market saying there's a sickness in the economy, that usually is meaning that the US 10-year is declining and the US 10-year and 2-year and 3-month are increasing. So things like Treasuries are often a place that Wall Street and other big fund managers will jump into. That's why Treasuries is often considered one of the safe havens of a crash or an economic bust, basically. Is it a safe haven again? Well, the good news is that all that interest rate hiking kind of stuff has really taken the sales out of Treasuries. If you look how much they fell off, if you own these things during the wrong times, you can see how dangerous Treasuries can be. In fact, they dropped 48.57% of their value. And I still think it's possible for Treasuries to reach down into these levels, especially if we go a 6% plus interest rate moving forward. If that starts to happen, Treasuries will decline. If you believe we're getting close to the terminal rate, though, and that the Federal Reserve will pivot and cut at some point soon, then Treasuries could be, a very interesting one. And look, volumes are up across the board here on TLT. It's an interesting chart. It came down to one of our critical levels recently. It's not really a trade, but there's some nice things on this chart. I mean, of course, you've got the bullish hammer, you've got the swing of the low, you've got the 61.8 fib. There's a little bit to like about the lows down here. No close below the lows, which is more important. Let's now look at the indicators that are the here and now. One of those is junk bonds. If junk bonds are getting trashed on, then that traditionally means there's a sickness in the stock market. They just don't know it yet. It was a bad day for junk bonds, but it wasn't a new low. It was just a bad day for junk bonds. Junk bonds were down 0.71. That's a decent move for them. And you can see the general trend recently has been decline in junk bonds. We'll continue to watch that story. What ran the most though? Well, it was US dollar. We've talked about how the US dollar is in basically an upward trend at the moment, that the stats do say that probably the US dollar will be faded in the future. So sometime during this rally here, we're going to get a pretty decent fade. And if we have a look at this chart, we know that we just got a pretty significant breakout. I mean, we broke past those 105.25 highs and we're moving into still our red box zone. So I had a watch reaction here. This was just the previous high. We actually have a gap on this white line here at 105.94, which was left behind. So there's like a little inefficiency that's left there. There's no real signs that the US dollar is weakening yet. Of course, the US dollar will weaken or turn as the Federal Reserve hits terminal rate. As they hit terminal rate and the talk of cuts happens, expect the US dollar to weaken. So it's in a critical level. It could sell off in these areas. The next zone for it to get to, I've speculated, is potentially around this 106.85. So if we breach past 105.94 and we don't instantly react with shorting around there, being the top end of the supply, then next equilibrium level should be around 106.85. So certainly things hitting up here for the US dollar strength. And you can see it's at a pretty interesting zone right now, but a super strong move over the last 24 hours. Now with really high increasing yields, what does that do? Well, it kills gold. So any hope of gold buying off this role reversal here was shot as soon as pretty much the Federal Reserve or Jerome opened his mouth. The market preluded this. It's like there was some loose lips out there and it just sold and sold and sold. And as we've said, I'm more neutralized on gold. I still think gold hits $3,000 over the next 5 years. And my expectation of that is based on cuts in the future. But gold hates higher interest rates. I've said it many times on this channel. I'll continue to say it. It hates it. I want money flow back into gold. And as of the end of January, I've been a bear on it. And I've said that here many times on the channel. There are some things that I feel more confident on. This one I've been bearish on for those reasons. It's coming down to a critical level. I want to see it hit 1792. Then we can talk about it a little bit more, or even possibly into the 1733s. But I want to see money flow come back in. We have not seen that yet. We have not got terminal rates. Any of those things have not occurred. What about the Widowmaker, natural gas, one of the most dangerous plays on the market? Well, it fell off pretty badly through the Friday close to the Monday open. It shows you how relentlessly dangerous this thing is. I still expect natural gas to pull back down to the 2.44s. It's probably in accumulation right now, but you need to be, are you trading it? Because trading it's going to be dangerous. Are you investing in it? Then you've got to think about decay and how you're going to pick it up. But yeah, look, this is the right type of thing to start a bottom, generally you'll pull back a little bit more aggressively to take people's stop losses out, especially I think there's probably quite a lot of stop losses underneath that price there, which is 2.55. So I'd like to see it take that low, move down into here, potentially buy off this zone. And if we see it kind of hovering around, it could potentially start to create a Wyckoff bottom. A lot of people interested in natural gas, but it's dangerous and you need to know how to play it. Let's move over now to the stocks, and we'll get started here with Tesla. So Tesla actually sold off very aggressively. It's consistent with our idea that this is a distribution schematic, and effectively we had a UT here, we've got an island reversal here, and we're basically weak on Tesla. Now, Tesla hit the expected weekly options low over the last 24 hours, so that's interesting. Do we now see a little bit of a relief rally in the stock markets? Well, I certainly think we could. I would say Tesla's going to do its own little dance at the moment. It had an enormous rally with massive gaps, e.g. here, and I think it's too coincidental that this market is showing a gap fill right on the 61.8 fib of a retracement, the golden fib ratio. So we've got a pretty significant looking distribution. We have lows here. If we close underneath the low, especially daily, weekly, that could create a cascade effect that gets us back into this price. I know people don't believe it, but I was saying that thing up here when we saw these, and I still think that although we might get a relief bounce thanks to the options low being hit, it's got those signs. There's a big amount of volume here, and if Wall Street want to play the dirty game, which they always do, then this would be a place where they trapped a lot of retail traders in at these prices. You can see that there's still a lot of FOMO in the stock. I mean, you come over to the options pricing, you can see here the big calls, the big puts. The current put bottom is in at 190. So again, it would be probably more profitable for the market to actually rally a little bit here into the Friday in terms of just paying off. It's not a big week though. 266,000 is nothing. It really pales in comparison to anything else. If we move forward to the big options expiration, you'll see 200 again, a lot of calls on that. And really a decent amount of potential for it to still drop off. 892,000, a totally different amount. We'll have to be watching anything that comes in on the ODTEs. So that's the one-day expiries, but realistically, it's not that great. Now, for anyone that was playing the Apple play, you'd probably be very happy with yourself. It was a really nice trade. You had the shooting star, and of course, then you had the follow through during the session, and it just kept selling and selling and selling and selling, and actually got the fill. So that's the first gap fill. Pretty nice, coming off that big zone that we know is huge for Apple. If you're a bull on Apple, you just want to close above 156. If you get that, well, most likely you're going to continue to get moves to 160 plus on this market, and things are looking pretty good. But it's been a huge rally in Apple. Lots of gaps left behind. We hit the options expected weekly high so early in the week, in fact, on the Monday, and it just wasn't able to hold those gains. So it's pulled back. I would probably expect a bit of relief in this stock through the next session, but we'll find out. Let's move over to Nvidia. Again, just kind of sitting, hovering. I'd like to see it drop again, hold this zone for a while, then gap low, creating an island reversal, and then that might be the end of the AI play. But at this stage, hard to go against it. No clear signs of weakness, but certainly a setup that could be occurring. We'll move over to one of the international markets, the Australian market. I've basically called this pretty weak recently. That's thanks to copper, mostly. I think copper is starting to weaken pretty heavily. That tends to have a big effect on the XJO. And for the Australian audience out there, we've still got our trend line intact, but generally speaking, I feel like we're going down to these levels. So more likely we're moving down to 71.50 and past maybe 7,000, around that 7,000 line. So I'm looking for buys, but not just yet. Let's move over to XLU. This is the utility sector. So I've said that this should theoretically run a little bit better than XLK. It didn't over the last 24 hours. It actually was slightly less or slightly worse, but it's got those right types of signs. You've got nice basing in terms of a little kind of island reversal. You've got volume. You've got period of time that should do okay. And although everyone hates utilities, and rightfully so, it has sold off pretty much all of last year. So you look at December into January, into February, it just sold. So it's a lagging sector. It's one that's super behind. And this will get no one excited. I bet you no one's talking about utilities at all. And that's the time when I start to come in and go, oh, okay, well, what's going on here? So interesting chart. Let's move over to the Qs. So this is the NASDAQ. We saw a double fill through the Monday session. It did better than the stock market, the S&P, in terms of the double fill. We got filled on both gaps. Then it's moved down. We're not quite at the lows yet for this one. But as you guys would know, I don't really use the Qs as my main read. They tend to be a great investment or trade vehicle, but they don't tend to be as good as the S&P 500 to find key levels. So how did we go? The answer is pretty good. We can actually remove some gaps now. So we'll remove firstly the 40.79, and then we can remove now the 39.81 because we hit both of them. So we've filled in the gaps, which is good. We've got one unfilled up here, which is probably a great sign for the bulls. And bears, you know what you want. You want that to be taken. The 200 SMA, the downward trend line test. If that gets broken, welcome to the land of 3820, 3800, 3750. You'll be excited if that occurs, but you need the 200 down. Now for the bulls, good news is you filled the gap. So this is what we expected. And around here is where I'd like to see relief. So if you get relief into a new high, I'm basically thinking we're going to crack past 4,200. Now, that might be against all of your technical reasons, fundamental reasons or macro reasons. The markets can stay irrational longer than you can remain solvent. The story of today is, yes, we expect the Fed to break something. Yes, we expect a US recession at some point. Yes, we expect bad things to occur. But the question is, when will the markets react the way that you believe? Remember, timing is a big thing. You can sit in cash, that's fine. But if you want to make money from trading and investing, then you've got to roll with the punches a little bit here. So we're back down to the key level. Now let's go and have a look at the expected options for the week. So the expected options low was 397.06. Funnily enough, we're basically at that level. So we had a gap fill, we had a 397.86, and of course we had a 61.8 fib retracement. So we can see here right on that level what we speculated would be hit. Now this is also a little demand zone. So we know that the market came up, created a little bit of demand, rallied through heavily. It's pulled back. If buyers are going to recommit, they should recommit through the next kind of 20 to 30 points. And if they do set up correctly, then we could be on a nice move. And if we move above these highs, which I don't know if that's going to happen yet, because of course at the moment, I think buyers might struggle around that 40-40 zone. So that could be a big problem for them. But if we do end up committing to a new high, start filling in this gap, we've got gaps all the way through. And I feel like once you bust this zone, unless you stop yourself at around 41.20, which is the most traded zone throughout here, geez, I'm saying like 4,300, 4,350 is very possible. So I'm playing a neutral game because I know money flows neutral. So if we know money flows neutral, we have to be open to the idea that markets come here into this area block, and that markets also could push a 4350 narrative. I know no one wants to hear it, but it's the reality of the situation. Neutralized market flow. That's annoying because it means that you can't have a strong bias either way. Maybe it's a good thing. So US 500 at the moment, we're looking at all of the facts and the figures. We're looking at a potential rally at these zones because the market has shown us that that's what it wanted to do. We have high, low, lower, low narratives, higher, high. We pull back. We find the gap fill. We find a lot of things to like about this zone. Now I'd like to see the market actually react to that. Let's move forward to the 10th, which is the options expiration. Would that make sense? It kind of does. 395 has too many puts on it. Not a huge amount, but still a decent amount of them. And 400 also has more puts than calls. So we know there's a decent amount of puts out there. Eventually the puts will get paid, but maybe it's not yet. 390 for the next week as well, March the 17th. We've got 157,000 units on 390. 394's got a lot. 400's got a lot. 3.34 million units of puts, and pretty much mostly puts. You can see it here. And Max Payne's sitting about 400 for that strike. So not really filling us with a lot of short confidence at this point. It's possible if the markets show us it and the price action shows us it, then of course you get involved in that action. But at this stage, we're at that kind of critical buy zone. What about Bitcoin? Well, it's doing its own thing. it didn't really struggle as much as you'd think over the last 24 hours, hovering around this zone. Here's our trend line. We've got our 2 watch reaction levels. If you're a real bull in this market, you need it above 25.2. If that happens, I'm thinking 30K is the next move on this market from a technical perspective, and it's stuck within a range. So that's kind of how it looks. So with Jerome Powell annoying us throughout Tuesday, he's very annoying. Then we move through to Wednesday, and he's back again to have a chat to us. 10 a.m. I'm not sure that will move the markets anywhere near as much. I doubt it. We got JOLTS job openings as well around the same point. And then as we scroll down here, we have the big news. Now, he basically said next 2 to 3 big bits of news will dictate 50 basis points. So I have a feeling that this is going to be a pretty big jobs number. The conventional way of looking at it is bad news is good news for the market. So they want to see drops in jobs. They want to see unemployment on the rise. If that happens, then I think the market will like it. Even though it's bad long term, the market will initially like it because it'll mean lower rates on the Fed. So be careful of this news and make sure to follow along. If you haven't already, come and check us out. Links in the description down below. Check out our free trading cheat sheets and data report coming soon. If you sign up for this, you'll get that as well. And of course, follow us on all the socials and different groups that we've got. So yeah, thanks so much for being part of the community. Do remember as well the giveaway that we've got at the moment. Sign up, it's super free to do. And what do you got to lose? You can just win a bunch of prizes. Thanks so much, guys. We'll catch you in the next one. Bye for now.